In this video, we'll talk about relative value analysis, how to screen for stocks, and understand the performance of a company versus its peers and others in its industry benchmark. What we'll look at is common approaches to investment, where relative value is one of those approaches, and then I'll give you an example which we often think of in the realm of real estate, and then show what that means for stocks, and look at what a good relative value analysis looks like. We'll talk about the most common approaches to price relatives, how those link to industries, and then finally how you can put all this together and do an analysis of a company and an industry. So there are three approaches to evaluating assets. One is fundamental analysis. That's where you do ratio analysis and look at growth, do discounted cash flow analysis, like we talked about the dividend discount model. Another approach is technical analysis, where we look at the movement of the stock price over time, looking at the demand and supply of that stock in the market, and what the price movement can tell us about whether the stock has strong momentum, if it's in a danger area. But the last area of analysis of assets is called relative value analysis, and that's what we want to talk about today. It's a very common approach to assessing assets as far as whether they're expensive or cheap. So getting into relative value analysis essentially is comparing the measure of an asset or security to some underlying fundamental factor. The value can be either price or enterprise value, specifically talking about stocks here, and we'll get into what those two things are and when you use one versus the other. Those fundamental factors can be anything that's readily available that helps you measure what that asset is producing. The most common measures can be things like earnings, revenue, the book value of the firm, and then there's several industry-specific factors that we can use that give us a better indication within a specific industry whether a stock is trading expensive or cheap. Relative value analysis doesn't assess whether something is rich or cheap in an absolute sense. If the entire stock market is overvalued, relative value analysis will not let you know that, but within a stock market, it will tell you which stocks are expensive and which ones are cheap relative to all the others. So that's our goal with relative value analysis, is to figure out relatively if a stock is cheap or rich versus other assets in a similar category. So let's do an example of real estate. We use relative value analysis in real estate all the time. So let's say you are looking to buy a house in a particular neighborhood, and all you know is that the price of the house is $150,000. With just that information, would you buy the house? Well, obviously not. That's not very good information. You don't know anything about the house or the neighborhood or anything else. So let's provide a little bit more information. So the price the price of the house is $150,000, and we discovered that there are two other houses in that same neighborhood that recently sold, one for $875,000 and another one for $675,000. Now do you buy the house? Well, you are more interested now in the house because it does look very cheap versus two other houses in the same neighborhood, but just the fact that they're in the same neighborhood still doesn't leave you with enough information. There could be definitely some major factors that would cause this house to be a lot cheaper. Obviously, there's something very different about this house than the other two houses, and that's what we're going to do now, is use relative value analysis to see if we can assess why this house is trading so much cheaper than the other houses. So an obvious thing to look at is the size of the house. So if we take into account the number of square feet that the house has, we discover that this house that we're looking at is selling for $75 per square foot, and those other two houses that just sold recently, they're selling for $250 and $225 per square foot. So now do we buy the house? Well, now we're getting much more interested. This house is very cheap even after you adjust for the size of the house, but there's obviously something going on with this house that we're not aware of that we'd like to know. So In this case, what we'd like to do is figure out why that difference is there. But do note that price per square foot is a price relative. We've now taken the value of the house and we've compared it to something that tells us about the value of the house, which is how large it is, and that is a price relative. So what if we went out and we looked for several different factors about the house, and we use that to adjust the house and try to figure out if, after you adjust for all these other factors, if this house is a good deal or not. Let's look at some of the factors we looked at. Obviously the size of the house, we've already adjusted that with their square foot, but we might ask, does it have a pool? How many bedrooms does it have? What is the quality of the kitchen? The landscaping, when was it last painted? Those sort of items that would impact how much you'd be willing to pay for this house. Those are what we call factors related to value. And then there's some factors related to risk, such as is the house in a floodplain? Does it have foundation issues? How far is the nearest fire department? What's the neighborhood like? Who are the neighbors? Those factors that might also impact how much you'd be willing to pay for the house. Let's say we brought all of those factors in. And doing that, we were able to get an R-squared of 91%, looking at 350 houses sold in the last 3 years. And using that regression analysis and applying all those factors to our particular house, we discover that our house should cost $150 per square foot, and we can buy it for $75 per square foot. Now we're very, very interested. This house looks like a really good deal. We can get it for $75 per square foot. When we adjust for all these factors related to value and risk, it looks like it should be $150 per square foot. So now we're very interested. This might be enough to purchase a house. We're still a little concerned, why is it going so cheap? And that's the same issue anytime we do relative value analysis. If we find a really good deal, our R-squared is 91%, which means there's 9% of items out there that we are not accounting for. And maybe this house is extremely sensitive to one of those other factors we haven't taken in consideration. So what if we can increase the R-squared to 98% by adding 2 more factors? Did anything horrible happen in this house, such as someone got murdered, or there's just something very uncomfortable about the house that's causing it to be cheaper? When we adjust for these last 2 factors, we discovered that the house should be selling for $80 per square foot. So obviously something horrible happened in this house, and that's the reason why it's going for $75 per square foot versus $150 all the other factors indicated. Now, if you don't care if anyone's murdered in the house or if there's anything else might have happened in the house, you have a house that, according to all your factors that you care about, is worth $150, and you can buy it for $75. So do you still buy the house? Well, if you're going to live in it for 20 years, maybe so. You're getting a house that's worth $150 per square foot based on all the factors you care about, and you can buy it for $75. However, if you're going to need to resell the house in 2 years, you may not want to buy it, because when you sell the house in 2 years, those 2 factors that you don't care about, which is someone was murdered in the house, the person you have to sell it to may find those to be important, and in that case they would not be willing to pay you $150 per square foot. They'd only be willing to pay you $80. And so you still have to take into consideration what others think about these factors, even if they're not important to you, if you need to be able to sell this asset in a short period of time. So this is relative value analysis. It ignores whether the entire housing market is expensive or cheap. It just asks, is the house that I'm considering buying, is it expensive or cheap versus other houses that I could buy or sell if we adjust for all the key differences between those houses. So the key to relative value analysis is we're trying to find a price relative that's appropriate to the industry. We'll talk about that. And what we want to do is make sure we adjust for key fundamental factors, those factors related to value, like we did with the house, such as how many bedrooms and how many square feet. Those factors related to risk, such as is it in the floodplain? We want to find factors that are specific to the asset we're looking for. So if we're doing stocks, we want to find factors that are specific to the industry we're looking at, in addition to factors that are generic to all stocks in all industries. So the more refined and more specific you can make your analysis, the more confidence you'll have that you're paying the right price for an asset. So all these things must be present to do good relative value analysis. You must have the appropriate price relative, and we'll talk about that, how you pick your price relative to which industry that you are. You must have some measure of value, and you must have some measure of risk. If you leave any of those out, in fact, if you leave out risk and you do this analysis, you may find firms that look inexpensive, but they may just be really risky. And so it's important that we have all of these factors together. So the goal here is to take the fundamental factors and the risk factors. For their house, it was number of square feet. How many bedrooms? For fundamental factors, it was, is the house in a floodplain? For the risk factors, those are our independent variables, and we're going to use those independent variables to try to forecast the dependent variable, which is, in the case of the real estate, was the price of a house per square foot. In a case of a stock, we might take return on equity as a fundamental factor, and how much debt the firm has as a risk factor to try to forecast price to earnings as the dependent variable. Higher fundamental factors should mean a higher price relative. Higher risk factors should mean lower risk factors, lower relative values. And we can see this in the dividend discount model, what we call the Gordon growth model. We said that the value of a stock, the price of a stock, should be its dividend divided by its discount rate minus growth. We can break up the discount rate into the risk-free rate plus beta times the market risk premium using the capital asset pricing model. When we do that, we get price equals earnings per share times payout. Earnings per share times payout, that is the definition of a dividend. What percentage of the firm's earnings are they paying out as dividends? We divide that by the risk-free rate plus beta times the market risk premium minus growth. If we move earnings per share over to the other side of the equation, we come up with the price-earnings ratio. Price divided by earnings per share equals the payout ratio divided by the risk-free rate plus beta times the market risk premium minus growth. This is a great formula to always have handy because it tells you a lot about what relative value analysis is doing. What it says is PE ratios should equal how much the firm is paying out of its earnings divided by the risk-free rate. Well, that's just general levels of interest rates, plus beta, well, that's the specific risk of the company we're looking at, times the market risk premium, well, that's the general level risk in the overall stock market, not specific to your company, but the overall market, minus growth of your particular company. That's something specific to your company. So what this means is when interest rates are higher, since the risk-free rate is in the denominator of the PE ratio, when interest rates are higher, PE ratios should be lower. When the specific risk of the company is higher, as reflected by beta, PE ratios should be lower. When overall market risk is higher through the market risk premium, PE ratios should be lower. And when growth is higher, since we're subtracting growth, when growth is higher, PE ratios should be higher. So essentially, PE ratios are a reflection of general interest rates, general market risk, your company that you're looking at, its specific risk as measured by beta, and your company, the one you're looking at, its growth specific to that company. And so that's what a PE ratio is, and that's absolutely true. PE ratios are very, very low in the early 1980s when interest rates were very high. PE ratios dropped dramatically in 2008, 2009 when risk increased dramatically in the stock market, when the market risk premium increased dramatically. And it is true that firms with high betas have low PE ratios and firms with low betas have high PE ratios. And it's true that firms with high growth have high PE ratios and firms with low growth have low PE ratios. All of that is in the together. Our focus is going to be on beta and the growth because the risk-free rate and the market risk premium is the same number for all companies. So that tells you about the general level of the stock market. But when you're trying to compare one company to another company, the only factors that are important important to that specific company are beta and growth. Now you notice I'm ignoring the payout ratio on the top of the ratio in the numerator, and the reason for that, in finance we assume as a firm increases or decreases its payout ratio, that a higher payout ratio will mean lower growth, and a lower payout ratio will mean higher growth. If a firm retains more of its earnings, it can grow faster. So in finance, we generally assume that the payout ratio and the growth ratio, as they move around, they offset each other. Firm has a higher payout ratio, that means the PE ratio might be higher, but then its growth would be lower, growth rate lower, that would push the PE ratio down, and those two perfectly offset each other. So the real focus is on beta, which is a measure of risk, and growth, which is a fundamental factor related to the company. Here are some PE ratios from some time ago, just to give you a sense of what this could mean. So Apple had a price to earnings ratio of 11, which means you paid $11 to get $1 of earnings of Apple. Google's was 29, Campbell's Soup was 28, and Amazon was 295 at the time I pulled these numbers. So when we look at that, is Apple cheap or rich? Well, if its PE ratio is 11, it's much lower than all the other stocks, so that means it's cheap. But that could also mean that Apple is just slow growth, and that's why its PE ratio is so low. It could mean also that Apple is just very high risk, and that's why its PE ratio is so low, or could be some combination of those. If you look at Amazon, by far the most expensive, yes, it's a rich stock. It's trading much higher than the others, but it also could be a high growth company. It could be very low risk, or some combination. If you look at Campbell's Soup has a very high PE at 28, much higher than Apple. I doubt that is because the market thinks that Campbell's Soup is a high growth company. I would guess that is because the market considers Campbell's Soup to be a very low risk company, and that's why its PE ratio is so high. So again, when you go back to that formula, PE ratio equals payout over risk-free rate plus beta times the market risk premium minus growth. You can see how firms can be explained of their PE ratio versus others by trying to assess their risk and growth versus other companies. So it's very important that we have the right numerators and denominators in these ratios. There's two numerators we can use in a relative. It could be the current price, and that the price, a stock price, reflects only the stockholders, or it can be enterprise value. Enterprise value is the stockholder value of a firm plus the bondholder value of the firm. So it includes both stockholders and bondholders. That's important when we're selecting the denominators for our ratio. The denominators can be earnings, which could be earnings per share, earnings for interest and taxes, earnings for interest, taxes, depreciation, amortization, etc. Book value. The book value of a firm is simply its assets minus its liabilities. Book value is also known as net worth or shareholder value. And we can look at the revenue. Those are the three most common ones that we use in finance. It's important in choosing between price and enterprise value that we match the capital providers in the numerator with the capital providers in the denominator. So if the denominator is before interest expense, so in earnings before interest and taxes, earnings for interest, taxes, depreciation, amortization, and revenue, those are all above interest expense on the income statement, then your numerator must be enterprise value, because remember, enterprise value includes both the stockholders and the bondholders. Since it includes both, you want to use a denominator that is before interest expense. If the denominator is after interest expense, such as earnings per share and book value, then the numerator must be the current price, because earnings per share, book value, since they're after interest expense, those belong only to the stockholders. So you want your numerator to only be the stockholder, which is the price. So earnings-based relatives can be price to earnings per share, but we don't use price to EBIT, price to earnings for interest and taxes. Instead, we must use enterprise value to earnings before interest and taxes. We have to use enterprise earnings before interest and taxes and depreciation and amortization. Why? Because both EBIT and EBITDA are before interest expense, so we want to use enterprise value. A PEG ratio is essentially the PE ratio divided by what analysts are expecting the growth of the firm to be over the next few years. So PEG ratio is a good earnings-based relative. We have some book value relatives. Price to book value is a very common one. There's some people who like to use price, not to book value, but price to maybe 10 years of earnings per share. Some way to look at the firm, so we're not looking at just 1 year of earnings, but looking at earnings over several years. So price to book value, you essentially have the net worth of the firm for its entire history. So all of its earnings are in that number. And price to say 10 years of earnings, you get a sense of the firm's value versus several years of earnings. And then there's revenue-based relatives. So enterprise value to sales is a very common one. Again, we use enterprise value, not price, because sales is before interest expense. So anytime you're using a number before interest expense, you must use enterprise value. So when do you use earnings-based relatives, book value-based relatives, and revenue-based relatives? Well, earnings-based relatives are important for industries where the focus is on revenue or earnings growth. When everybody's talking about growth, how fast they're growing, they're extremely high, fast growing industries. Things like technology would definitely want to use earnings-based relatives. Book value-based relatives work really well with three types of industries. First, industries that have a lot of capital requirements, like utilities and manufacturing. They like to use price to book value. Cyclical companies or commodity-based companies like energy or materials, because their earnings are very, very volatile, looking at price to just 1 year of earnings could give you a really deceptive story, because the earnings might be at a peak or at a trough. In that case, price to earnings will not really give you any good indication of the firm's relative cheapness or richness. So you want to look at price to book value to spread out that very cyclical and volatile earnings. And then finally, industries that are focused on return on invested capital. That's banks, insurance companies, other financial services companies. Price to book is the most common ratio they use for those firms. Firms that are really focused on return on equity, return on assets, those firms tend to use price to book values. And then revenue-based relatives are used predominantly in industries where margin is the most important factor, such as in retail. Consumer staples, consumer discretionary, those type of firms frequently look at enterprise value to revenue. So what can you do with the relative value analysis? Well, it's good for screening for stocks to put into your portfolio, and you could even use these with bonds. They're not relative value analysis, not frequently used with bonds, but you certainly could look at a bond price versus its spreads or its CDS spreads or its credit ratings. It could use it to value a non-publicly traded company. If you're trying to sell, if you have a subsidiary that's a bank and you want to sell that bank, spin it off and sell it, you might look at its book value and look at the price to book value of publicly traded banks and try to get a sense of what your bank might be worth if you were to sell it. It can help you determine benchmarks for a company, public or private. So if you run the analysis and you can see what the market thinks certain factors should be relative to the industry, it gives you a sense of what you should shoot for, maybe your gross margin or your net margin or return on equity. What factors should you have if you want to try to get your stock or the value of your company up to a certain level. And it also allows you, through regression analysis and looking at these factors over a large number of companies, to understand what does the stock market think is most important to the valuation of these companies, which is a very powerful piece of information to have. So when you bring all that together, it really comes down to understanding which numerator and denominator to use, and make sure you're comparing price relatives to things that are after interest expense, enterprise value relatives to items that are before interest expense, so you don't mix and match your ratios. And then you want to make sure you're using a ratio that is particularly important to the industry that you're looking at. When to use earnings-based relatives, when to use book value-based relatives, and when you use revenue-based relatives. If you get that correct, then it opens up opportunities to do some pretty sophisticated analysis, especially when you use a resource like the Bloomberg machines, where you can bring in a lot of data for a lot of companies. You can run analysis and really determine which stocks are trading rich and cheap, and have some confidence that you have you're buying stocks that are rich or cheap, rather than buying stocks that are simply cheat because of bad reasons, because they have bad fundamentals or they're high risk. Thank you very much.